And welcome to ETF Edge, your go-to place for everything exchange-traded funds. I'm your host, Bob Pisani. It's being called the big rotation, out of thematic tech and into value, energy, commodities, dividends, and anything that's inflation-themed. Now, let's talk to three people who are in the thick of it. Jeremy Schwartz is the Global Chief Investment Officer for WisdomTree. Christian McGoon is the President of Amplify and CEO. And Mike Akins is the CEO of ETF Action. Jeremy, let's start with the thematic tech. We've seen outflows in January in many thematic tech ETFs. You run one of the biggest thematic tech ETFs. That's the cloud computing ETF. WCLD is the symbol. Had $1.5 billion in assets a year ago. Now it's under $1 billion. Sort of characterize for us, this is the big question I keep getting, the flows in and out of thematic tech right now. Are we anywhere near a bottom, or what are you seeing?
Well, and what's interesting to see, like, where is the market rotation happened? We do believe in the inflation theme. We do believe the Fed's hiking rates aggressively. So as we continue the conversation, that's a #1 theme for us. So it's not surprising the big sell-off you've had in the biggest growth stocks. It's amazing, actually. Something like the S&P is only 7% from its all-time highs, and you've got the clouds down. They've already taken the hit. They're down 1/3 from their highs, and so they were the earlies to the bear market. Now the question is, do they get beaten up too much? They are the fastest growing stocks. They're very different than the large cap FANGs, which have been holding up the market pretty well despite a few of their recent troubles. And so I think you got to see if some of that growth sell-off turns around. I think the cloud stocks would be prime positioned.
Yeah. Same question for you, Kristen. You run the Transformational Data Sharing ETF. The symbol there is BLOK. Everything blockchain, essentially. Your sense of investor flows in that space right now?
Yeah, it's really interesting, Bob. We've actually seen inflows to block this year. I think there's been people buying the dip. Certainly, Block is having a nice bounce today, as well as cryptocurrencies. It's a fund that's fairly sensitive to the price of Bitcoin. We've seen some inflows into our battery ETF, BATT, kind of, I think, due to legislation issues. We're about 50% thematic, 50% growth or income and hedged equity. We've seen more flows into our income and hedged equity than we have into our thematic growth side. So definitely seeing a rotation, but there are a few bright spots in this thematic growth area.
All right, I want to move on to where the money is going rather than where the money is going out of. So, Mike, investors seem to be reallocating their portfolios. Outflows, growth, thematic tech, inflows, value, energy, dividend, inflation theme, commodities. Give us a sense of what you're seeing. You're sort of watching the entire ETF universe.
Yeah, I think definitely there's an inflation narrative playing throughout the market. You're seeing it in ETF flows. On the thematic side of things, flows have plateaued. We haven't seen a lot of inflows, but outflows have not been crazy yet. So it's good to see that investors are staying the course there. But really, broadly speaking, I look at the sector data, and you can see big shifts out of technology, comm services, into energy, into financials. What's unique about that, specifically, if you look at the combination of all sector and industry, U.S. sector and industry ETF data, there's over $600 billion in those ETFs. And right now, energy is the most overweight relative to the S&P 500, with 11% of total sector and industry ETF being in energy. So you can really see that rotation playing out, not just in net flows, but how it relates to the broader market and allocations.
Yeah, well, there's no surprise about the inflows in energy with oil at $90, a 7-year high. That sort of makes some sense. Now, Jeremy, WisdomTree has several products that fit into this reallocation strategy. You're very strong in dividend ETFs. You've got a great lineup there, starting with the Quality Dividend Growth Fund, DGRW there. Now, you're looking for companies that are growing earnings as well as with some growth characteristics. Tell us about this fund right now.
Yeah, that's around a $7 billion ETF. It's been the flagship for how do you find companies that can grow dividends into the future. And a lot of companies just look backwards to say, have you grown your dividends for the last 20 years or 10 years or even 5 years now? We were the first firm back in 2013 saying, can you look forward using a combination of quality metrics, return on equity, return on assets? I call those your Warren Buffett quality screens. Buffett says, I like high return on equity, companies that don't use a lot of debt. And that's what we packaged in that screen, combined with earnings growth expectations from a dividend, which is a more value type universe. It's a very interesting combination today. It's been one of the best performers in the large blend category the last 3 months because of that defensive rotation. It's sort of top 2% of all large blend funds because it's of that dividend screen, but good quality earnings that are supporting that dividend.
Yeah, I would note this is that classic situation where you're growing, not necessarily having a big dividend. So Apple and Microsoft don't necessarily have large dividends, but they are growing the dividend, which is why they show up here, along with the traditional, Procter & Gamble type and Johnson & Johnson names. So, Jeremy, keeping on this, commodity ETFs, we're also seeing inflows in. You have an enhanced commodity strategy fund that's out there as well, symbol GCC. That's a mix of agriculture, precious metal, livestock, industrials, in metals in general. Tell us about that too.
Yeah, that's if you look at, we have 75 ETFs in the U.S. That's the top performing to start 2022, up 7% this morning. And what it tells you is, there is this fear of inflation. Rates are heading up from the Fed. What do you do for a standard 60-40 portfolio allocation? Commodities and inflation-sensitive places are one of those diversifiers. We still think inflation's here with us. And so what do you do if you think stocks can be hit by rising inflation and a rising bond rate? That the bonds don't provide as much diversification as they used to. Inflation-sensitive assets like commodities are a good portfolio hedge, and we've taken a diversified approach. An interesting thing is, historically, it cost you a lot to roll futures. It cost you like 5% a year for 2.5 decades because the futures curve. That's changed, where you're now getting paid 4 to 5% in these diversified commodity baskets.
Well, that's because things have changed, Mike. It seems like you can't lose with the commodities at the moment here. So the futures curves in commodities, a lot of them are in backwardation right now. The front month prices are higher than future prices farther out. So what's that telling us? And what's the implication for owning a commodity ETF?
Well, it's significantly positive is the short answer. But, I think to Jeremy's point, we've seen broad-based commodity ETFs that include GCC and others go from 10 billion in AUM a year ago to 20 billion today, and no sign of slowing down from a flows perspective. But obviously, all of these strategies have unique structures, and it's something to really note when you talk about backwardation and contango. The environment is much friendly for those future roll strategies right now, and it's a tailwind in an area of the market that's already hot. So I think we'll see continued flows into this space, and rightfully so, in our opinion, ETF action.
Yeah, it seems like, Christian, any ETF with the title inflation, that's all you got to do is put inflation in the word. It's got inflows right now. You just launched an inflation fighter ETF. The symbol is IWIN. And again, this is a very interesting mix. I'm curious about how you put this together. Stocks, gold, Bitcoin, commodities. I know the stated goal is not just to provide a capital appreciation, but to do it in inflation-adjusted terms. Explain that to us, and how did you get this curious mix together?
Yeah, so if you look at just the plain commodity ETFs, there's some benefits in owning that, and certainly there are a lot of people who will want to own these futures-based ETFs. What we wanted to do is create kind of a hybrid approach where you have inflation-sensitive stocks that are exposed to commodities. There isn't a land, futures contract out there, but you can buy land development companies. You can buy commodity REITs that have some of the benefits of REITs and land ownership, but also the exposure to commodities. You can buy asset miners, gold miners, copper miners, etc. We want to combine those with exposure to commodity futures, corn and other agriculture, energy, gold, and even Bitcoin. So we wanted to create a diversified basket where you could own a percentage of your portfolio to fight against inflation and hedge, not necessarily take the full bet on commodities and backwardation and contango, but at the same time not ignore the equity space as well, because many of those companies are quite sensitive to inflation if you get that selection right.
Yeah. Jeremy, there's a lot of interest in I don't know what you would call them, specialty products that you sort of mix and match assets that used to be considered fairly exotic. They're not so much anymore. You have the Wisdom Tree Efficient Core ETF, NTXS. That's an actively managed portfolio of equities and Treasury futures contract, leveraged to, I think it's a 60-40 portfolio. Again, a little bit on the exotic side, but it's getting interest. What's the idea behind this product?
Yeah, this fund is approaching $1 billion. We launched two versions, international and emerging markets, which are NTSI and NTSE, that have also scaled very quickly. So there's probably about $1.1 billion in the combined family. And the idea is getting more for your money, sort of get capital efficient is what efficient core stands for, that for every dollar, you really get $1.50 of exposure of 90 cents of equities and 60 cents of bond futures. And when you think about the challenges for inflation-sensitive assets like commodities, like gold, where do you create room in them in portfolios? And we've heard a lot for the diversifiers that they had below par expected returns for the last decade. People couldn't sell bonds for them. They didn't want to give up the equity upside. And so these funds are designed so that you can put 2/3 of your capital up and get that same 60-40. And then you have 1/3 of your capital either keeping cash for spending or to buy commodities or gold or any other diversifier like managed futures that might hedge some of what's going on in the market risk.
Jeremy, do you have problems explaining this to people? I mean, are you selling most of these funds to institutional people or people who are professional money managers? I mean, the average retail investor is going to have a little bit of a hard time getting their head around some of these specialty products. I wonder if selling them is a problem or whether it's really just professionals that are putting it in portfolios.
You know what, Bob? What's fascinating about this fund is this was a product of the people, born on Twitter, and it was actually driven by retail, I think. I think the early investors were retail, that people give the retail some more credit, that they are able to understand these things and how it fits in portfolios. And then, and actually later, after retail was some of the early investors, then you saw some large RIAs, some other institutions. It is a well-known strategy in the RIA world, institutional world. And so I think that professional investor came on after retail, but I don't think it's that hard to understand. I think people did get the use case, even though it's a little bit more sophisticated than your traditional standard 60-40 allocation.
Yeah, and if you don't want fixed rate bonds, and nobody seems to want them, Jeremy, there's a floating rate bonds, and
yes.
You've got a floating rate treasury fund, USFR, I believe it is, U.S. Frank Robert.
Yes.
And what's in this one here?
So this is I think this is the fixed income fund for the next 2 years. When you think about, there was a lot of uncertainty over what's happening in stock world. The Fed has communicated they're on a path to hiking rates. During the last rate hike cycle, the floating rate treasury was the highest yielding treasury by the end of the cycle. Our view is that's going to happen again. And so USFR is the way to play the Fed rate hikes. The U.S. floating rate treasury auction this week was already up 29 basis points ahead of the Fed funds target. Those floating rate treasuries are already reflecting the Fed hikes. And so USFR is really the best way to play the Fed.
And what do they own in terms of floating rate treasuries? Explain, make sure people understand what's going on here when you buy them.
Sure. A floating rate treasury has the shortest duration of any treasury security. The rates reset every week with the latest auctions. And so it's just a U.S. Treasury security. I mean, it is a government-issued security. They issued them in 2014. It was the first new government security after TIPS were issued in '97. And so it's just a standard government bond, but instead of a fixed rate, it's a floating rate that gets reset every week. So it's a pretty standard government security.
Yeah. Now, Christian, you have one of my favorite titles for an ETF. You have the Black Swan ETF. The symbol is SWAN, S-W-A-N, and you have a Q version, a Q Swan. But the Swan tracks an index, speaking of specialty products, long-dated options, as I recall, on an S&P 500 ETF. And you also have U.S. Treasuries with an average of a 10-year maturity. So how did this work? You get some equity exposure through options, but you also have some downside risk. That's the theory, right?
That's right. It's kind of the classic black swan barbell approach, where you have a risk-off asset like treasuries, and then you have a risk-on asset like the S&P or NASDAQ. And what this allows you to do is get about anywhere from 50 to 70% of the return of the relative index, whether that's the NASDAQ or the S&P, but have considerable always-on hedged exposure to the market. So a quick example would be the decline that we saw in COVID, where the S&P was off over 30% in several days. Black Swan was down just 9% during that time. And we've seen more interest in this just because of the geopolitical tension. Certainly people aren't making tactical calls really on treasury exposure here, but we know when market volatility increases, when there is a geopolitical event, investors go risk off, they focus on U.S. treasuries. Treasuries then have a negative correlation to the equity market, can be an important part of a hedged portfolio exposure should we see disruptive events or black swan events.
Yeah. You know, Mike, speaking of trends, another thing that keeps coming up is a lot of interest in international investing over U.S. investing. Now, the U.S. has outperformed Europe and most of Asia for more than a decade. That's been pretty clear, particularly the Europe part of this. What's the theory behind international investing in 2022? Why does it keep coming up when I talk to ETF people?
Well, I think broadly speaking, the environment has changed, right? We've gone from an environment where everything was tech-related, growth-related, and the U.S. stood to stand best from that, and it did. And as a result, you saw flows significantly tilt to the U.S. year after year after year for the last decade. And you add that up, and it's quite amazing. If you look at $5.5 trillion in equity ETF assets here in the U.S., 4.2 trillion of that is in U.S.-focused only ETFs. So 75% of all equity ETFs in U.S.-listed funds is in U.S.-only names, whereas if you look at ACWI as a proxy, only 58% is in U.S. So from an allocation perspective, there's been a huge migration into U.S. As favored, and now we're already seeing early evidence of that trend starting to change. So like year to date, we've got 55 billion in flows into equity ETFs, and almost half of that has gone to funds focused on companies outside of the U.S. So I think it's just a natural fit into the broader story of growth falling out of favor. A lot of these international markets are better situated with higher allocations to cyclicals. Valuations, we know, is a big discussion right now, and international DevX US emerging are at historical discounts to the US from that perspective. So pretty much there's a lot of factors driving this, but it's important to note it's got to go a long ways to get back to even somewhat close to even.
Right, that's a problem. But Jeremy, Wisdom Tree partially got famous on its hedged, currency hedged ETFs years ago. The HEDJ, as I recall, hedged currency hedged Japan. You have a currency hedged Europe one. We haven't brought that up at all, but what kind of flows are you seeing in those or interest in those?
For sure. I mean, it's interesting. The dollar has surprised a lot of people. I think a lot of it ties to the Fed. And we had seen some chunky inflows, sort of a little bit of rotation in the last few months. Japan started to see a lot of interest in the value rotation. A story I'm watching closely. You saw Buffett buys Japan a few years, maybe 18 months ago. He bought a number of the Japanese trading companies. He did it on a currency hedge basis, by the way. And I think there's some rumors that he's buying more Japan right now. So I'll be focused on that story. But we're seeing that rotation to international, rotation to value. Even some of our international value baskets are outperforming U.S. value now. And so I do see that in performance right now.
All right. We're going to have to leave it right there. Folks, this is the best brain trust you can get out there. This is where the money's going. These are the guys who are following it. And that does it for this week's ETF Edge. My thanks to Jeremy and Christian and Mike. Now, I've asked Mike to stick around for our ETF Edge podcast to discuss some broad 2022 trends in ETFs. And remember, you can see all of the shows on our website. They're all there, etfedge.cnbc.com. Everybody have a healthy, happy, and safe trading week.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.